Welcome to Talk Tickers. We're your shortcut to understanding today's key earnings calls.
And right now, we're diving into Occidental, a big name in oil and gas.
Yeah, we're going to pull out the essential financial results, strategy updates, and what they're forecasting. Give you the core info.
Okay, so first quarter, pretty strong across the board, actually. All three segments. Operating cash flow before working capital hit $3 billion.
Solid number. And production.
Oil and gas averaged just over 1.39 million BOE per day, barrels of oil equivalent.
Right, BOE. And I was right on target.
Bang in the middle of their guidance, yeah.
What really caught my eye, though, was the domestic operating costs. Oil and gas OPEX came in way under expectations.
Yeah, $9.50 per BOE. That's quite efficient.
Definitely. And profit-wise.
Adjusted profit was 87 cents per diluted share. The reported profit, 77 cents per share.
Okay. And free cash flow. Always a key metric.
About $1.2 billion, again, before working capital adjustments.
And they finished the quarter with a decent cash pile, too, didn't they?
They did. $2.6 billion in unrestricted cash. Gives them flexibility.
Okay, so clearly a strong start. Let's dig into how they're doing it, especially keeping those costs down. What's driving that efficiency?
Well, a lot of it seems to be coming from the Permian Basin. They've made some, significant strides there.
Like what specifically?
They cut the time it takes to drill a well by 15% compared to last year, especially notable in the Delaware Basin part of the Permian.
15% faster drilling. That's a big jump. How does that translate beyond just speed?
Directly to cost savings. Permian unconventional well costs are down over 10% year over year.
Over 10%? Wow, wasn't their target lower? Like 5 to 7%.
Exactly. They beat their own target. And because they're so much more efficient, they can actually drop 2 drilling rigs in the Delaware.
Drop rigs.
But still expect slightly increased production from that area. It's that classic doing more with less.
Fewer rigs, potentially more output. That's capital efficiency right there. So looking bigger picture, company-wide production, what's the trend?
The projection is for growth from Q1 through the second half of the year.
Good.
That's driven by finishing up turnarounds, maintenance in the Middle East, plus activity in the Gulf of Mexico.
And their onshore stuff.
Steady development there should more than offset any volumes they lost from selling off assets.
Got it. Now, beyond the U.S., you mentioned the Middle East. They seem to have some big things happening in Oman.
Yeah, that's a key part of their international strategy, it looks like. They're in advanced talks.
With the government?
With the Oman government, yeah. To extend their Block 53 contract another 15 years out to 2050.
15 years, that's significant. What's the potential resource size?
Could unlock over 800 million gross barrels of additional resources.
800 million barrels. Wow.
And they think it'll have competitive returns, boost cash flow starting in 2025. So potentially quite valuable.
Is it just extending the current stuff or new finds too?
They also announced a significant gas and condensate discovery, North Oman.
Oh, okay. How big?
Estimated over 250 million barrels of oil equivalent. And crucially, it's near existing infrastructure.
Right. That always helps keep development costs down. Makes sense.
Definitely speeds things up, potentially. They're working on appraisal and development plans now.
Okay, so that's oil and gas. Accidental isn't just E&P, though. How did OxyChem, their chemicals arm, perform?
OxyChem actually did better than expected, adjusted earnings of $215 million.
Even with weather issues?
Yeah, they overcame some weather-related operational headwinds. The focus there remains on being a low-cost leader.
And midstream, the transport and marketing side, also strong.
Very strong. Midstream and marketing significantly outperformed guidance.
Why was that?
Mostly strong gas marketing optimization. They capitalized on some regional price differences in the Permian during third-party maintenance.
Smart trading.
Basically, yes. And they also had healthy software sales from that segment.
Interesting how those different pieces contribute. Okay, let's shift gears slightly. Low carbon ventures, what's happening there? It's increasingly important.
Yeah, they highlighted some concrete progress. A big one is a 25-year carbon offtake deal with CF Industries.
For carbon capture?
From carbon capture and storage, yeah. At their Pelican Hub in Louisiana. It's a large-scale project.
Does that mean big capital spending for Occidental soon?
Apparently not. They stressed this deal doesn't require near-term capital expenditure from them. It's more about securing long-term CO2 volume.
Okay, strategic positioning. What about actually removing carbon? Direct air capture.
Their Stratos facility, the big D-Day plant in West Texas, is moving towards commissioning. Startup expected in the second half of this year.
Still on track then.
Seems so. And they mention ongoing R&D through carbon engineering showing potential to cut D-Day costs further down the line.
Right. Cost is still the big challenge for D-Day. Now, all this requires financial strength. How's the balance sheet looking? Debt.
Deleveraging is still a major focus. They retired $2.3 billion in debt just this year so far.
How did they manage that?
Mix of things. Selling non-core assets, getting cash from common warrants, and just organic cash flow from the business.
And longer term, over the past year or so.
Over the last 10 months, they've paid down $6.8 billion in total debt.
Wow. That must save a lot on interest payments.
Projected annual interest savings of about $370 million, which is significant.
Definitely frees up cash flow.
Yeah.
Have they addressed near-term maturities?
Yep. All 2025 debt maturities are now retired, gives them breathing room.
So more deleveraging planned.
They said they're actively looking at options, potentially more divestitures, but they also want to keep a healthy cash balance. It's a balancing act.
Makes sense. Okay. Given all that, what's their take on the market right now? Commodity prices have been, well, volatile.
They acknowledge that. Lots of uncertainty, demand, policy, supply, leads to price swings.
So how are they reacting?
They've made proactive changes to this year's plan. We mentioned the Permian rig reductions and other project optimizations. That's allowed them to cut their capital guidance for the year by $200 million.
Cutting spending. But what about costs?
Also projecting $150 million in OPEX savings for 2025. So trying to be leaner, more agile maybe.
Less CapEx, aiming for lower OPEX. But holding production steady overall for the year, right?
That's the plan. Second quarter production should tick up slightly from Q1. Full year total company production guidance is maintained.
Right.
But they do expect the mix to shift slightly, a bit less oil cut for the year overall.
Okay, noted. And they lowered the full year operating cost guidance too.
Yeah, from $9 down to $8.65 per BOE, reflecting those efficiencies.
What about near term for the other segments? Midstream, chemicals.
Midstream earnings likely down a bit in Q2 because of lower commodity prices, but they expect that to be offset by mark-to-market gains in oil marketing, accounting adjustments basically.
And the big chemical project, Battleground.
Peak spending for that hits in 2025, around $600 million, then drops sharply to $300 million the year after.
When does it start up?
Mid-2026 is the target, expected to add about $160 million in operating cash flow annually. And one more thing on cash flow, they revised some midstream contracts, crude transport deals. That should provide a pre-tax cash flow boost. About $200 million in 2025, then $400 million a year from 2026 onwards.
So it sounds like a lot of these pieces are lining up to really boost free cash flow in the next few years.
That seems to be the core message. They're anticipating about $1 billion in incremental pre-tax free cash flow just from the non-oil and gas sources in 2026.
$1 billion extra. Wow.
With more growth in 2027. Driven by Battleground, those midstream contracts, Stratos finishing, and of course the lower interest from debt reduction.
Okay, let's zoom out. Longer term. What are they thinking about the overall energy landscape, particularly U.S. production?
Interesting comments there. They suggested Permian growth might plateau, slow down sooner than people thought.
Really? Why?
Industry-wide activity levels adjusting, basically. And related to that, they think the peak for U.S. oil production might happen earlier than the 2027-2030 timeframe they previously saw.
So maybe a more constrained U.S. supply picture ahead.
That seems to be the implication. They also made sure to highlight their own portfolio transformation, more U.S. onshore shale focus now.
Right.
But also stressing they still have substantial conventional resources. Gulf of Mexico, Algeria, Oman, those offer future growth options.
And the DXE tech. Any link back to oil?
They see it potentially enhanced oil recovery, EOR, down the road, using captured CO2 for EOR.
Okay. So if you're tracking Occidental, what are the main signals, the key takeaways from this call?
Well, the focus on cost cutting and strong Permian results points to resilience, even if prices stay volatile.
Makes sense.
The Oman extension potential and that gas find highlight international growth avenues, diversifying their cash flow. The low carbon progress, especially that CF Industries deal, positions them for the energy transition, however it plays out.
Imology.
Big debt reduction, improves financial flexibility, maybe opens the door for higher shareholder returns later.
Right. Buybacks. Dividends.
Potentially. And finally, cutting CapEx while holding production steady suggests better capital efficiency, getting more bang for their buck.
All right, brings us to our This Is Not Financial Advice segment. Time for some, let's say, creative thinking based on the call.
Okay, here's an outrageous but plausible idea. Scenario 1. Accidental keeps crushing these debt reduction goals. Management keeps hinting at shareholder returns once targets are met.
Uh-huh.
So, maybe a medium-term long position in the stock, say 18, 24 months out,
Betting on.
betting that the eventual buybacks or dividend hikes are much bigger than the market currently expects. Fueled by hitting those debt targets early and keeping costs super low. That's the outrageous part, the scale of the return.
Okay, banking on accelerated deleveraging translating into surprisingly large shareholder returns. Got it.
Yeah.
What's another one? Maybe something on the ESG side.
Yeah, idea too. Look at the carbon capture deal, the Stratos DA project moving forward.
Okay.
Consider a paired trade, go long accidental,
And
a hand short a peer. Another oil and gas company, maybe one with less visible, less tangible progress on CCS or low carbon tech.
what's the outrageous element there?
You're betting the market starts re-rating energy companies based on ESG factors, maybe sooner or more dramatically than expected. And Accidental's lead in these areas gets valued at a significant premium compared to, let's say, a pure play fossil fuel peer lagging behind. It's a bet on a near-term ESG re-rating.
Definitely some provocative ideas there. Food for thought.
Yeah.
So wrapping this up, our deep dive into Accidental's call shows a company really zeroed in on operations, strategic international plays, and adapting to market swings.
Yeah, key takeaways. Strong Q1, real progress cutting costs and debt, and promising moves in Oman and low carbon.
And while the market's always got uncertainties, management sounds pretty confident they can deliver consistent results and build value.
Which leaves a final thought for you, the listener. What does this intense focus on efficiency, combined with these strategic partnerships, tell us about how major energy players might navigate the future? How are their strategies evolving in this changing landscape?
Something to ponder. We encourage you to keep exploring.